controlling your limbic system, the thinking fast system that is your emotionality, your fight or flight, your pleasure centers. If you can't control your limbic system, you will die poor. That is a hell of a statement that talks about how important taking the emotionality out of your investing process is.
Well, welcome to Speak Up on the Wealthion Network. I am your host, Anthony Scaramucci. Joined with me today is a best-selling author, Barry Ritholtz. He spent his career investigating behavioral finance and data analytics. He is obviously the chairman of Ritholtz Wealth Management. He's got Josh Brown, another famous financial pundit, as one of his partners. And Barry wrote an amazing book. It's hard to believe that it's 16 years ago, Barry.
But the I'm like clockwork. Every 15 years,
okay.
The sequel is in 2040.
You're like the locust. So Bailout Nation was a phenomenal book. I read that book, and the reason you and I met is I went up to you at an event in 2009 and said, Barry, I read your book. It was an awesome book. I learned a lot in your book. And I learned a lot in this book, by the way. And I want to start where we were in the green room, Mr. Ritholtz. This will be a bestseller. It's incredibly well written. But I hate the title, How Not to Invest. So how did you get that by your publishers?
So, I've had Bailout Nation did well. And in the ensuing years, I've had a number of publishers and friends say, hey, it's time for another book. And I kind of held them at arm's length, in part because I was busy. We were building the firm. We're 5+, depending on where the market closes today. We're $5+ billion, 75 employees, 3,000 families we work with. And that was my focus. And then the pandemic hit. And I started to have a little more, hey, I'm not commuting. I got a little more free time. And so I when Morgan Housel came to me and said, dude, you got to write another book. The world needs to hear from you. And I'm like.
And Morgan Housel, for those listening in, is another best-selling author. He's written a few books now, but his breakout book was The Psychology of Money. He's been on this network with me, and he writes the foreword of your book.
Right. And The Psychology of Money wasn't just a bestseller. It's 7 million copies. It's just an insane number for a finance book. And so I kept on coming up with excuses. And one of the excuses was there's been 10,000 books written about how to invest over the past, century. None of them have really turned investors into anything more than meh investors. And the area I focus on, look, there's some great books on behavioral finance from Danny Kahneman and Dick Thaler and Morgan and Jason Zweig. And do we really need another book on behavioral finance? And then there are all the data analytics books. I'm not going to do a better job than Jim O'Shaughnessy and What Works on Wall Street. So I come back from vacation in this Christmas break, and you have a few days before January 2nd rolls around, and I just started looking at some of my old research notes and quarterly calls, and I start going through columns, and Morgan's publisher was Harriman House. So I reach out to Morgan and Harriman House and say, a lot of the stuff I focus on comes from clients and prospective clients and media questions. And as often as not, I am forced to debunk some financial bullshit or another. And so I said, hey, how do you feel about the title, Debunking Financial Bullshit? And of course, the British, being very proper, oh no, we would never go that way. And besides, after Harry Frankfurter's book, literally on bullshit, no book with that in their title has done well. But
there's one book, actually. I was going to just bring it up to you.
That's Frankfurter's book.
What's the book?
Okay. Well, so the book.
What was the title of the book? How Not to
So the book on bullshit is from Frankfurter. There's a fake AI book stealing my title that came out a week before mine by an author that doesn't exist. It's an AI-generated 35-page nonsense that eventually the lawyers will send a cease and desist. But that's not a real book.
No, the only book that's done well is How Not to Die. Do you remember that book? How Not to Die. Okay, right. That's a good book. Okay,
just find out where you're going to die and just stay away from that place.
Generally,
says Charlie Munger.
Don't want to die, and so that's one of the books. But let's go to a couple of things in the book that I really.
Well, before you do that, you didn't like the not in the title, How Not to Invest,
right?
And when I first said, okay, here's what this book is about, it's all the things not to do, the general reception from people was, oh no, you don't want to put that in the title, it's such a negative. And when I like that idea, let's go with that. When I got the first couple of cover designs, hated them all, had the same experience with Bailout Nation. John Scherfius did the comic for the cover for Bailout Nation, said, I got your cover, and it was perfect. So when I got a bunch of cover proposals, I hated it. I said, here's what I want to do. I want to do How Not to Invest with not in a different color, and I want it to trace a stock market line crash. So when you first look at it, and the graphic designer at Hammer House took the idea and really made it sing, having How to Invest in white catches your eye. And it's only when you look at it a second time, you go like, wait a second, is this how to invest or how not to invest?
Yeah, well, I as I said before we started, I love the not in black and the how to invest in white. But when I read the book, a couple of things about your book. It's unfiltered. It's a distillation. And the truth of the matter is, as I regale my investment career, which has had its ups and downs, and I'm in the how not to phase of my life. So I really enjoyed the book, meaning I looked at this thing and said, hey, man, I get where you're going because this is me. I wish I had read this book and been smart enough, however, as well. You got to read the book and be smart enough to exercise the book at a younger age. I'm ready to exercise your book now at my age because you and I are contemporaries, but neither that's here or there.
But you can't
my
exercise.
Yelling at me saying, did I read her script? She's yelling at me, see, because she doesn't know my relationship with you in the banter. But yeah, I do have.
We live about 15 minutes apart from Manhasset to Locust Valley, or you're really closer to Plandome. But here's the thing that you learn when you deal with investors and people across the course of their life. Someone could have handed me this book at age 25.
Right.
And you're just too young and enthusiastic, and you're too unseasoned.
Yes.
You're not ready to accept the truth.
Got to touch the hot stove, Barry Ritholtz.
That's right. You grew up. So quick contemporary story, since we're contemporaries.
Go ahead.
I grew up on Long Island. I was a Mets fan. And when I was a kid, the Mets had a batter named Dave Kingman, right? Dave Kingman used to hit these home runs. People think this is hyperbole, but it's not. These home runs went so far in Shea Stadium, they would leave the stadium and break windshields in the parking lot. That's how hard and far this guy, like it seems mathematically impossible to hit an 800-yard home run. That's how big a bat this guy swung. The reason he's, not a Babe Ruth or, go through your list of favorite hitters is that he just struck out so much. Brutal. And I think most investors are Dave Kingman.
You remember that home run he hit at Wrigley Field? That was literally the bomb of bombs. Okay,
I think like it broke a window in an apartment building. Nobody has ever hit the ball as far as this guy has hit the ball. It's crazy.
You and I lived the same era of New York, and so we know Dave Kingman and we know Duffy Dyer. We know all these sad sack Mets that never could win a championship after 6 years.
You did have the Dwight Gooden. You did have a bunch of people.
We were older then.
Darryl Strawberry.
You were already out of college. I was already out of college when that happened. That 9-year-old excitement of the 1973 World Series it was well behind this. But
Right.
let's
86
go.
was a long time ago.
Let's go to this book, Handsome, because there's a couple of things in this book that I really want to hammer to people, and that is emotional investing. Emotional investing. And you've been an emotional investor. I have been an emotional investor. Most people listening to this program have been emotional investors. So let's go to the how not. How do you not be an emotional investor by Barry Ritholtz? Go.
So 3 simple steps. First, have a plan, figure out why you're investing, towards what ends. We could have a whole nother conversation about purposeless capital. Bill Huang, Archegos, more is not a good strategy. When you have a goal, then you could deploy the appropriate amount of risk to obtain that goal through a financial plan. You have a core portfolio that's broadly indexed. It doesn't matter if it's the Vanguard Total Market, the S&P, whatever it is, it's your core. And then feel free to add, I like to say the tree is your broad index. Add some ornaments and garland and popcorn strings. And that's your, hey, I have a little bit of momentum. I have a little bit of crypto. Here's some India. Here's some emerging market value. Whatever you want to flavor that stew with, to mix metaphors, knock yourself out, but at least guarantee yourself you'll get market returns over the long haul for much of your portfolio, because the academic literature makes it really clear. In any given year, let fewer than half of active managers beat their benchmark. 5 years, that number is 83% fail to beat their benchmark. 10 years, it's over 90%. And 20 years, it's virtually nobody. And the people who, the 0.3% who do are the Peter Lynch's, Warren Buffett's, Will Danhoff's. You know their names because they're the Michael Jordans, LeBron James, Steph Curry, to switch sports metaphors, of their field. No one would want to go out and play one-on-one against Michael Jordan or LeBron James. And yet we're willing to play one-on-one against these rock stars. It's called home field advantage for a reason. And the average investor just is way too cocky and way too sure of themselves, versus they would never do that if it was basketball or football or what have you.
Well said. I mean, I think there's so much in the book. I mean, I'm buying a stack of these books, handing them out to my summer interns. I'm buying the book, giving it out to my children, because they need to read the book. And then every 10 years, I'm going to recommend to them that they read the book again, because as they get wiser and they get their asses kicked more, Barry, they'll be more willing to listen to what's in the book. But there's one thing you wrote in the book, and I'm going to quote. And thank you. Is Charlie Ellis still alive, by the way?
Yes. Charlie. Yeah. I just had him on the podcast 2 months ago. His new
Legend.
book is Rethinking Investing. It's like 96 pages.
Yeah, like the old book.
He's just such a charming, delightful guy.
Legendary guy. And he wrote a great book about Goldman years ago. Charlie is a real leading.
By the way, chairman of the Yale Endowment, board of directors of Vanguard, ran Greenwich Associates. A legend in the industry.
Legend in the industry. I learned so much from him. One of the best things I learned from him, and I'm about to get into it with you, is market timing. Don't be a market timer, because if you're out of the market 10 days, you end up with a ridiculously low, even lower than the bond market like return. You have to stay in it and ride the volatility curve, accept the bumps and scrapes of being an owner. But you say something which is so clear and so simple, and it's so Charlie Ellis-like, and I'm going to quote from your book: "The truth is counterintuitive. Avoiding errors is more important than scoring points." It couldn't be more crystal clear, right?
So that traces back to a paper that Ellis wrote, I want to say in 1976, 75. You and I were probably in high school or junior high school when that paper came out. I think it was the Journal of Portfolio Management or something like that. And he likens, and he by the way, he turns this into a book 20 years later, but he likens investing to tennis. I play a little tennis. I'm not that good. But this resonated with me because tennis, like investing, are two games in one. The professionals, the 0.01% of people who play tennis professionally, they win by scoring points. They hit the ball with power, with accuracy. They score aces on serves. They hit the ball where the opponent isn't. They put enough topspin on the ball that it stays away from the opposing player's sweet spot. They kiss the line. Like everything they do is they score points. That's the winner's game. That's how the professionals play it. The other 99.9% of tennis players in the world, which includes you and me, we don't win by scoring points. We lose by making unforced errors. And we try and operate outside of our abilities, outside of our skill set. So we double fault on a serve. We hit the ball long. We hit it wide. We hit it into the fence, into the net. We hit the ball with too little topspin. So, which means the mechanics of your stroke isn't great. So the ball just comes right back up to the sweet spot of the other player, and he could put it wherever he wants, and that's where you're not. And so it turns out that if you just, as a tennis player, make fewer unforced errors, don't try and kill it on your serve because you're not that good. Just put the ball in play. The ball comes back to you, just return it. Keep it within the field of play. Let the other guy think he's going to score an ace and hit the back wall. And it turns out that's very hard to do because you really want to play like, I'm not Roger Federer, you're not Rafael Nadal. None of us are these amazing players. Serena Williams would kick all of our asses, 6-0, 6-0, 6-0. We're not them, but we want to be. And if we only make fewer mistakes playing against other amateurs, that's actually how you win. And the parallel to investing is identical. You're not Will Danhoff. You're not going to be a great stock picker. You're not Warren Buffett. You don't have this endless amount of capital from Geico that allows you to wait out value stocks to return to their full value. None of us are Boaz Weinstein, who's buying closed-end funds at like this deep discount and then agitating as an activist to force the manager to, hey, if this is 20% below NAV, go buy arbitrage. Where are you going to get a better return? Go buy your own stock and close this gap. We're not those people. We are simply punters trying to work our way through this. And if we just stay within our ability, if we just make fewer mistakes, you end up 90% better than 90% of everybody else who's hitting the ball out, who's hitting the net, who's thinking they could stock pick, who's thinking they can market time. And the data, there's no ambiguity here. The data is clear. As a group, as a species, we are not good at that.
So letting you go because it's just such crystal clear simplicity and brilliance. Before I take questions from the outside audience, holding periods. Let's go over the holding periods.
So I mentioned purposeless capital. If you have purposeful capital where you're managing money towards a goal, that'll define your holding period. So one of the people in my office just had a baby. We set up a 529. Hey, guess what? In 17 years, that kid's going to college. That's your holding period. So you're putting money away towards that. And there's just no reason to play with it. Make regular contributions. It grows tax-free. You have a 17-year holding period. If you're thinking that I'm saving for retirement, all right, so depending on your age, if you're in your 20s, 30s, 40s, you have as much as a half a century to go. The miracle of compounding is so amazing. And humans, we grow up in an arithmetic world. We've evolved where we don't need to understand compounding. But in the book, I tell a story. Two guys go off to World War I. They each have a small fortune. They have $1,000, which 1917, that's just an unbelievable amount of money. One of them buys the market, the equivalent of a broad index. The other one buries it in mason jars in the backyard. And so whenever you hear people say, the dollar has lost 96% of its purchasing power over the past century, technically true, but the dollar was never supposed to be a store of value. It's a medium of exchange. The families of both of those guys, the one who buried it in the mason jar, well, how much purchasing power does $1,000 have a century later? Much, much less. But to show you how we don't understand exponential math, we don't intuit compounding. When I ask people, what do you think $1,000 invested in equities is worth a century later? Oh, $1,000. It's got to be 800,000, a million, 1,000,007, like 3 million. Someone even said, oh, it's got to be $5 million. When I show them the table of compounding at just a very simple 8%, and with dividends, you actually get closer to 10%. 10% over a century is $32 million from $1,000. People don't understand that. As wealthy as Warren Buffett is, most people don't understand that 50% of his wealth has come in the past 7 years. It's just shows you the effect of compounding.
Made it all of it after age 60, which is good for you and me, bro.
Right. That's right. It's really astonishing because look, we evolved to adapt to challenging conditions and changing conditions on the savannah. We were not built for selecting this muni bond or that equity fund. It's not an organic, intuitive thing. And so simply making fewer decisions and making less errors. And when you make a decision, you're thoughtful and rational, to use Danny Kahneman's phrase. You're not thinking fast, you're thinking slow. And thinking fast is where the emotionality comes from.
Yeah.
I love the quote from Bill Bernstein I started a chapter with. So Bill Bernstein, literally neurologist, brain surgeon, like, oh, that guy's a brain surgeon, literally, starts managing money for doctors and then pivots and becomes a wealth manager. He said, controlling your limbic system, the thinking fast system, that is your emotionality, your fight or flight, your pleasure centers. If you can't control your limbic system, you will die poor. That is a hell of a statement that talks about how important taking the emotionality out of your investing process is. None better. Hard to find someone better situated to communicate that than Bill Bernstein.
Well, I think you've done an amazing job, and I think you're at the right point in your life, Barry, to write a book like this, because the book you wrote in 2008, the great analysis of the collapse, how it happened. But this book is really a legacy book for you, and God bless you for it. This is a book where people say, hey, young kid, this is the Peter Lynch book of our time. You remember One Up on Wall Street?
Oh,
Peter
sure.
Lynch?
How to Beat the Street, One Up on Wall Street, use what you know.
This is the Peter Lynch book of a new generation. So let's take some questions from the audience.
Wait,
thank you.
Before we go to questions, I just have to share one thing with you. So writing Bailout Nation was very cathartic. I had to get it off my chest. But what made that book a little bit of a slog is it was never done, because every time I think I'm ready to submit the manuscript, some other company would blow up. God damn it, I got to rewrite that chapter. Oh, Countrywide. Washington Mutual. Like it started with Bear Stearns is what kicked that book off. And then every month, some Lehman and AIG blow up. And here's Goldman. And here's Morgan Stanley with the Mitsubishi. Like each chapter had to be rewritten 4 times. This book was really a joy to write. I hope it comes across how much fun it was putting together, because nobody was blowing up. Part of the reason I wrote the book is, Michael Batnick in my office. Mm-hmm. Like, all right, he's telling that story again. I can hear Batnick's eyes rolling. You know what, Mike? I'm going to put it down on paper and let's see what people think.
All right, good for you. Let's go to the questions. I got a few questions. We always pick 3 questions from our audience that we distill. Barry, what do you think about gold's meteoric rise to 3,000+? This is Angela from New York.
Sure. So if you're a trend follower, if that's your particular flavor, gold has been a wildly successful trade over the past, let's call it 5 or 6 years. The challenge with gold over the past century is it's more of a trade and less than an investment. I started on a trading desk, so when I see gold, and by the way, I have a vivid recollection of when the GLD ETF was first rolled out, and I'm on CNBC leading up to the financial crisis, and like, yeah, you could buy some gold here. And I remember the anchors actually snorted at me. They actually laughed at me. So gold is a trade. The challenge with gold is it's not a productive asset. There's no dividend, there's no yield, there's no coupon. So when you're buying gold or many commodities, you're buying it in response to economic conditions, some crowd psychology, but it's not the sort of thing that's going to compound over decades and centuries. Gold goes through these long periods where it crushes everything, and it goes through these long periods where it underperforms. So, hey, anybody who's a momentum trader, anybody who's a futures trader, my buddy Mike Koval, I wrote the forward to his book. I don't know, it's got to be like 10 years ago. Trend following talks about when gold is hot, every trend follower, every MTA guy is all over it. And when it cools off, you can't touch it with a 10-foot pole. So if you're a trader, if you're a speculator, I talk in the book about having a cowboy account and take 5% of your money, do whatever the hell. I'm a junkie. I started on a trading desk. I'm always looking for that dopamine high, and I do the dumbest out of the money puts and calls on broad market indices. Dumbest way to speculate, but it scratches my itch and I write in the book that allows my big dumb lizard brain to leave my real money unmolested. If you're a trader, if you're a trend follower, gold is fantastic. One of the things I talk about extensively in the book is how not to get fooled by people who are facile in number. The famous Joan Robinson quote, we study economics not to understand the economy, but so as to not be fooled by other economists. You really have to be careful with when people cherry pick starting dates of charts. I could show you a chart that shows gold kicking equities ass. If you go back to the right point, right to before late 07, I could show you other charts where equities kick gold's ass. It goes back and forth. You have to understand how easy it is. Anytime you see a chart, always look at the starting point. Hey, why are they picking that date? It's one thing to say, here's 1 year, 5 year, 10 year, 50 year, big round numbers. But when someone says, look at this 12 and a half year chart, hey, why? So if you're a trader, if you're a speculator, gold is a fantastic asset to trade. But if you're putting money away from 100 years or even for 20, 30 years, I want to bet on human innovation. I want to bet on the genius of people solving problems, figuring out how to provide goods and services to the economy, to people who are consumers, because history tells us that is a spectacular way to earn a good return.
Well said. And you do go over a lot of that in the book. Let's go to the next question. What recent evolution in finance excites or concerns you most?
So some of the things, so after, 90 chapters, admittedly short, but a lot of things, don't do this, don't do that, beware of this, careful of that. The last 10 chapters of the book are like, all right, I can't just tell you how not to do everything. Here are 10 things to do. One of the things I talk about is tax alpha. And it really applies to everybody. Now, the deduction against ordinary income is $3,000 a year of losses and blah, blah, blah. But if you are somebody who is sitting on a substantial amount of gains, and if you've been investing any length of time, the odds are that that's the case. If you have a concentrated position in fill in the blank, NVIDIA, Apple, Amazon, United Health, Bitcoin, ETH, it doesn't matter. You will probably generate more net returns by managing your taxes better than you will by market timing or whatever you're doing with those holdings. So about 6 years ago, we started working with O'Shaughnessy for their direct indexing product. I have never been a fan of direct indexing most of my career. It was clunky. The interfaces were terrible. You got these giant, like 1,000-page quarterly statements. It was terrible. They figured it out. And so now Canvas and O'Shaughnessy was purchased by Franklin Templeton. We were the first client. We're currently the biggest client. I want to say, somewhere around a quarter of our assets, about $1.5 billion, are in Canvas. Obviously, those numbers fluctuate based on wherever we're closing. But that sort of thing has been really interesting. Currently, the next technology, we're working with Eric Golden, former bond manager of Fidelity. He set up Canopy, which is the same basic concept, but for fixed income. How do we generate the max after-tax returns for people who want income stream, want munis? And then there's a handful of other tax-related things. Meb Faber has an ETF, TAX. Wes Gray, the guys over at Alpha Architect, ETF Architect, bunch of geniuses, former military guys. Everything they do has a military precision to it. They've come up with these really interesting ways that carefully track the IRS guidelines and the 40 Act guidelines as to here's how to manage these big capital gains. If you're up 50 bips or down 50 bips against your benchmark, nobody really pays attention to. Like clients aren't going to notice that. But figure out, hey, we saved you $300,000 this year in taxes, and here's the thing, and here's what we worked out with the tax team and your accountant. They're like, wait, what? You saved me how much money? I don't have to pay the IRS? People are like, that is real cash in their pocket. They're not writing a check. And I think, Dave Noddig loves to say the investing is a problem that's been solved. We know how to invest. We just don't do. Most of us just don't do it because emotions and all these other things. I think organizational alpha, tax alpha, and behavioral alpha there's so much more headroom there than I'm going to beat the S&P 500 by 50 basis points.
Fantastic. Let's go to the next one. Barry, what's your take on crypto? This is Michael from Florida.
So I think I have a sort of different perspective. And I think people are like, it's always fun, and you and I know each other a long time, to kind of be out there on the ledge and then watch the rest of the crowd slowly come towards you. So I look at Bitcoin as a big Magnificent Seven type tech stock. And if you look at the market cap, and I'm not looking at where it closed, but let's call it 1.7, 1.8 trillion, something like that. It's bigger than Facebook. It's smaller than Google. If you think of Bitcoin, like a giant tech company, and I love the concept of smart contracts. I wrote a post about this a couple of years ago. Hey, there is going to be an application. I'm a big music guy. I go to a lot of shows. If Taylor Swift is tired of all the scalpers making more money on her shows than she makes, she could put her tickets for sale on a blockchain where her own fans who get a special number get access to this. They buy a ticket inexpensively for $50. If they choose to resell it, if they choose to scalp it, well, you could sell it for $1,000. But because it's on the blockchain and she's Taylor Swift, she's going to say, hey, I get 60% of this. You get 40% of it. And she gets to sell tickets to her hardcore fan base at a reasonable price. And then the scalpers who are coming in, they're cut out. And if someone decides to flip the ticket for a profit, hey, it goes to the artist who should get the money, not a rentier, not a middleman that doesn't add anything to the process. So I think they're some people have criticized crypto as a solution in search of a problem. It's a technology. We will figure out ways to deploy it. The uptake has been slow because there's a lot of entrenched interest, just like search was a problem. Google figured that out. Just like
cloud was a problem.
Cloud was a problem. Amazon figured that out. Office productivity software was a problem. Microsoft figured that out. Interface and ease of use was a problem. Apple figured that out. So I look at Bitcoin as, it's a bet that there's going to be some application that justifies this enormous, somewhere between Facebook and Google is this company. Now, it's not exactly a consumer-facing company yet. It's really a B2B solution in terms of at least that use case, the smart contracts. But there are going to be some other ideas. And, to some degree, there's been a lot of speculation. But isn't that true about NVIDIA? Isn't that true about Apple and Amazon? Hasn't there always been speculation in a new technology in a fast? Sure, Juniper Networks blew up and Global Crossing was a disaster and Pets.com hit the shitter, but Pets.com led to Chewy. And some of these other companies, eventually, they were a little early. Bitcoin seems to have been early, but it's still an evolving thing. And, hey, it's not Google. It's sort of Facebook without all the acquisitions. Facebook would be nothing without, think of the Instagram and WhatsApp and go down the list of Facebook. The reason they changed the name to Meta is Facebook is now your parents' social media. That's not where the young people are, and they haven't been there for a decade. But think of it those ways, and I don't think of it as an asset class. I think of them as Bitcoin is a giant tech company, and I'm really intrigued to see how the world adapts to it and how they make their way into our life. The iPhone had like a 2-year head start. And so the iPhone is ubiquitous. It's everywhere. I stop and think about, I board a plane with my app. I take an Uber with my app. I check my portfolio with my phone. Like everything you do in your life is on your phone. If Bitcoin is going to have staying power, it will eventually be that B2B end. Hey, none of us buy NVIDIA products. We get to use NVIDIA in the next layer. If you use Perplexity or ChatGPT, NVIDIA is somewhere in the background. But I don't buy NVIDIA chips. I suspect Bitcoin is going to be in the same place.
All right, I'm going to leave it there. I'm going to give you the last word. The title of the book is How Not to Invest. But it's really a book about how to invest. And you're an amazing guy. We've been friends for a very long time. And we have the same shared life experience, you and me, baby. Okay, it's you, me, and Billy Joel, my man. Stuck on Long Island.
Thank you so much.